Well, again, the broader indices mixed at least right now here at the open, with the Dow off just about over 100 points. The January jobs report coming in much stronger than what the street had anticipated. That's why we're looking at the Dow under pressure. The Nasdaq, though, holding on to gains. A lot of that having to do with the strong numbers that we got out this morning or last night from Amazon and Meta. Let's talk about this, how investors should be squaring the two. We want to bring in Sonia, Meskin, BNY Mellon's investment management head of U.S. Macro. Sonia, it's great to have you here. So first, that jobs print, it took us by surprise. It took many investors by surprise. What do you think that means then for equity movement and some of the volatility concerns creeping back into the market?
Sure. I think, of course, the January number itself was very strong, but the revisions were also strong. And there's a lot of talk about the seasonality effects in the January number. But then if you look at the 3-month average gains, up to January, those are quite a bit stronger. And then what would be consistent with wage growth, that itself would be consistent with 2% inflation over time. So we like to say that wage growth of roughly around 3.5% average hourly earnings is consistent with roughly 2% core PC inflation over time. And what we're seeing is 4.5%, both in the gains of average hourly earnings year over year, and also roughly backing out what we saw in headline gains again over the last 3 months in the NFP. So yeah, the labor market is obviously strong. What does this mean for equities? On the one hand, of course, rate-wise, got to pare back expectations of early cuts from the Federal Reserve. On the other hand, just as you mentioned, if growth overall holds up, which the consumer is a very big part of this economy, if the consumer is employed and relatively optimistic in terms of spending, then the prospects for the services sector, which is the biggest part of this economy, are also relatively sanguine. Of course, there's certain elements that are going to be suffering, such as the regional banks that you guys just discussed earlier. Whether this is systemic and it's going to spread to the rest of the economy, I think 2023 has proved that the economy is relatively resilient.
What's wild, Sonia, is that coming into this report, we were having week after week of conversation around the number of tech layoffs that were coming forward, or layoffs that seemed like it was significant percentage cuts from household name companies, and wondering if it was going to show up in a report like this, maybe not this report specifically, but whether it would change the narrative of the entire labor market. And it doesn't seem that that's the case at all.
Well, we still have large sectors, healthcare, large part of the professional services that continue to hire. So while the layoffs can grab headlines, I think that it's the net, that's really the most impactful for the consumer.
Sonia, how are you looking at this from an investment standpoint in terms of the winners and losers that we could see play out in the market? Because yes, if you have a strong jobs sector right now, obviously that could point to future gains here for many in corporate America. So how are you then using a number like today in trying to identify potential winners off of that?
Of course. Well, fundamentally, I think this number just tells us do not stay in cash. The story for 2023, I think, from a lot of strategists, a lot of shops, was that, cash is king. And what we're seeing is a continuation of the actual story that, was going on the ground, is that no, cash is not necessarily king. It's good to diversify. It's good to stay invested. Equities, especially, I think, stronger balance sheet companies offer good opportunities, and fixed income continues to offer good opportunities, because you can capture price appreciation on the downside when the Fed does begin to cut, but you're also getting yield.
And so for any investor, and we were talking about this a little bit earlier this morning as well, for investors that were trying to bank on, perhaps they were extremely bullish for a March rate cut or even a May rate cut, how does this change the calculus for their portfolio?
I think, folks that are not day traders, folks that are kind of more medium to long term looking, whether the Fed goes in March or goes in May or June, I don't know if that changes the story all that much, right? Maybe it changes how far down they're going to go. But at the same time, again, if we come back to the growth story, if the economy is strong enough and this level of rates, maybe with some adjustment, is roughly appropriate, then it really shouldn't change the outlook for stronger companies, be it on the equity side or on the fixed income side.
Sonia Meskin, who is the BNY Mellon Investment Management Head of U.S. Macro. Sonia, thanks for taking the time here this morning. Appreciate it.